Welcome back to the deep dive. Today we're doing something, well, a little different.
Yeah, bit of a shift in focus.
Usually we're looking at, broad market trends or we skim the surface of a product.
Right.
Today we are absolutely putting on our senior analyst hats. We're looking at a structural paradox in the market.
It's a paradox that, it keeps a lot of sophisticated investors awake at night.
Exactly. We're calling it the revenue dilemma. And to solve it, we are breaking down the investment thesis for a company called HumaTek.
Mm.
But, and I need to be crystal clear right off the top here,
Yeah.
this is not a tech review. And even though HumaTek operates in the humanitarian aid sector, this is not a feel-good story about charity.
No. If you're looking for a heartwarming story, you're in the wrong deep dive. We're looking at this strictly through a financial lens.
We're stripping away all the sentimentality.
We're looking at the mechanics of a very specific, very aggressive financial architecture.
We're looking at an asset class worth, what, $320 billion that most investors just treat as radioactive?
And we're looking at how you structure a bet to capture that value without getting burned. It's all about the how.
So let's set the stage with this revenue dilemma. I think everyone listening knows this feeling. You look at your portfolio, and it just feels like you have to choose between two extreme personalities.
It's a bipolar market. On one side, you have the crypto and Web3 world.
Right, the moonshot side. You're chasing that 100x return. It's exciting, it's high octane. But let's be honest, often there is no floor.
Zero floor.
Yeah.
It's pure speculation. If the narrative shifts, if sentiment turns cold, the value it goes to zero.
Because there's no revenue backing it, it's vapor.
Exactly. It's like walking a tightrope without a net.
Yeah.
You're betting on the greater fool theory half the time.
But then you look at the other side of the ledger, the traditional route. You buy into a SaaS company, a logistics firm, a blue chip.
Safe. It's got cash flow.
It's boring, but in the best way.
But it has no ceiling. Or rather, the ceiling is concrete and it's very low. You're just capped by linear growth.
I mean, if you want to make 10% more revenue, you have to hire 10% more sales reps. It's a grind.
The multiples are compressed.
So that's the investor's paradox. High risk with infinite upside or low risk with capped upside. But the materials we're looking at today, the white papers, the briefings on HumaTek, they claim there's a third door.
They call it the dual action engine.
And the claim is that they've engineered a way to merge the safety of a traditional business with the explosive upside of a crypto asset.
Which, I'll admit, when I first heard hybrid model, I kind of rolled my eyes.
Me too. It usually means master of none.
But when you actually peel back the layers of this dual action engine, it's quite elegant. They aren't just mashing two things together. They're using one to solve the failure points of the other.
So let's break this down. The mission for this deep dive is to understand how you take a market humanitarian aid that was previously a black hole for capital and turn it into an investable asymmetric bet.
And to do that, we have to start with the market itself. You mentioned the number $320 billion.
That's the annual figure. That is a massive amount of capital flow. I mean, if this were fintech or healthcare, a market that size would have hedge funds swarming all over it.
But in the aid sector, the smart money stays away. And, for good reason. Historically, this sector has been viewed strictly as a cost center.
It's a sinking fund.
That's the industry term. You put money in, and it's gone. It's a sunk cost. There's no expectation of an ROI because the return is social good, which you can't spend.
Right. You can't audit a smile, and you can't deposit good vibes into a bank account.
But it's worse than just no return, isn't it? The source material talks about this labyrinth of intermediaries.
Yeah, that sounds like a bad fantasy novel.
It's a nightmare for capital efficiency. Think about the journey of a dollar. A government treasury writes a check. That capital doesn't just teleport to a village in need.
No, it goes to a global agency, then a regional office, then a local NGO, then a contractor.
And every single time that dollar changes hands, someone takes a bite.
Currency exchange fees, administrative overhead, banking delays.
And, frankly, corruption. It's just friction and value leakage at every step.
The stats in the briefing were, they were shocking. They estimate that between 40 and 60% of the value just evaporates before it ever reaches the intended beneficiary.
Just pause and think about that. As an investor, if you had a logistics company shipping, say, iPhones, and you lost half your inventory between the factory and the store,
You'd be out of business in a week. Your shareholders would sue you.
you'd be shorted into oblivion. But in the aid world, this leakage has just been accepted as the cost of doing business.
It's a black box. You put money in the top, and you just have to trust that it comes out the bottom.
But you can't verify it. And in finance, trust without verification is just unmanaged risk.
Precisely. So this is the setup. You've got this massive volume of capital moving through a broken, leaky pipe.
And HumaTek's thesis isn't to pour more water into that pipe. They're not trying to be a better charity.
Right, they aren't asking for donations.
No. They're building the financial infrastructure to patch the pipe itself. They're applying a hard-nosed fintech lens to a humanitarian supply chain problem.
Which brings us to the dual action architecture. This is the real meat of the deep dive. How do you actually monetize this?
Okay, so the briefing describes two distinct components, the floor and the ceiling. Let's start with the floor. This is the anchor.
This is the product called HumaDash.
You could think of HumaDash as the operating system of aid. Technically, if we just look at the specs, it's a B2B enterprise SaaS platform.
Okay, so on this side of the business, they're a software company. They sell licenses to NGOs, government agencies, big foundations. But here's the question I always ask with SaaS. Why now? These are giant, slow-moving, bureaucratic organizations. Why would they buy a new software platform? What's the trigger?
The trigger is fear, or to be more precise, regulation. We are entering an era of extreme compliance.
The compliance driver. I saw that in the
It's
memo.
massive. Governments, the US, the EU, the UK, they're tightening the screws. They're tired of the black box.
They're passing legislation that says if an agency can't prove with audit-grade certainty where their funds went,
They lose their funding. It's an existential threat.
it really is. If you're a major NGO and you can't account for that 40% leakage, you're done. The old model isn't just inefficient anymore, it's becoming illegal.
So they're forced to modernize. They need a tool. And HumaDash is that tool. It provides SOC2 compliant tracking. It turns the black box into a glass box.
It gives them a dashboard where they can see every dollar move in real time.
Okay, so from an investment standpoint, this part is pretty standard. It's about fees.
Licensing fees, implementation fees, support contracts.
Right. And this creates annual recurring revenue, ARR. And this is absolutely critical for the asymmetric bet thesis.
Yeah.
This revenue stream creates a financial floor for the company.
It's the safety net.
Exactly. It protects the investor from the typical volatility of the crypto market. Even if the crypto winter comes, even if speculation dries up completely, you still have a company with multi-year government contracts generating hard revenue.
It anchors the valuation in real-world logic. It keeps the lights on.
And it prevents the asset from going to zero. But, and here's the rub, a SaaS company usually has a cap. You can only sell so many licenses. Your growth is linear.
Right. You want to double your revenue, you usually have to double your sales force.
Which brings us to the second part of the engine, the ceiling, or as the briefing calls it, the uncapped ceiling.
This is where the crypto element comes in. This is HumaCoin.
Now, we need to be very, very careful here. Because usually when serious investors hear the word coin, they think meme. They think vaporware.
They think Dogecoin.
Right. And the briefing is very careful to distinguish this. This is not a speculative asset in that sense. HumaCoin is the liquidity layer of the platform. It is the settlement vehicle.
Let's unpack that mechanically. How does settlement vehicle translate to value?
Okay, so imagine you're a donor in New York sending $10 million to a relief effort in Southeast Asia. In the old world, that money moves through SWIFT, it goes through correspondent banks, gets converted to local currency, takes 3 days.
And loses 4% in fees.
Painful. In the HumaTek model, that transaction flows through the HumaDash ecosystem. But under the hood, the value moves across the network using the HumaCoin token as the carrier.
So it converts fiat to token, moves instantly, and then converts token back to fiat at the destination.
Correct. The token isn't the product. The token is the rail. It's the digital piping.
And here's why that matters for the ceiling, right? The value of the SaaS side is limited by how many software licenses you sell.
But the value of the token side is limited only by the volume of global giving.
That is a massive distinction. We are talking about token velocity.
Exactly. As the volume of aid flowing through the system grows from millions to billions, the demand for the token scales linearly with the utility of the network.
So let me see if I have this right. If the global aid market is $320 billion and HumaTek captures even a fraction of that flow, say 5%, that is billions of dollars of demand pressure on the token.
Billions. And it's regardless of how many new software licenses they sold that quarter, they have decoupled the upside from the operational constraints of a software company.
They are capturing the velocity of the market flow.
This is the definition of the uncapped ceiling. The SaaS side keeps the lights on. It pays the engineers. It prevents the asset from collapsing.
And the token side captures the exponential growth of the market volume.
And that is the synthesis. That is the asymmetric bet.
It's brilliant in its construction, because usually you have to choose one or the other, value or growth, safety or speculation.
Here, they're saying you can have both. The argument is that the floor creates the confidence to hold the asset. You know the company isn't going bankrupt because they have government contracts.
But the ceiling provides the reason to buy it. You have downside protection anchored by government-grade compliance, and you have upside potential exposed to a tokenized global market.
It really shifts the philosophy of the entire industry. It moves from trust-based charity, which is uninvestable, to verification-based utility.
There is a phrase in the source material that I circled 3 times. It said their goal is monetizing the proof of aid.
That is the key concept. Listeners need to really grasp this. HumaTek isn't selling aid. They are selling the proof. In a world where trust has eroded, proof is a commodity. It's a valuable resource.
And HumaTek has built the refinery for that commodity.
It's an interesting way to think about RWA, or real-world assets. We hear that acronym thrown around a lot.
Usually it's tokenizing real estate or treasury bills, static assets.
But this is a different kind of RWA. This is tokenizing a service layer. It's tokenizing the efficiency of capital movement.
And it's doing good by doing business, but not in a fluffy corporate social responsibility way.
No, it's doing business by solving the inefficiency of doing good. And for the investor, the doing good part is almost a byproduct. The primary product is financial efficiency.
You're investing in a machine that stops value leakage.
And the fact that the value happens to be humanitarian aid is, from a mechanical perspective, irrelevant to the return.
That sounds cold.
It is cold. But that's the briefing. We're looking at this as analysts. It's about the architecture of value. If you can save 40% of $320 billion, you have created immense value. The dual action engine is just the mechanism to capture that value for the investor.
It creates a strange but powerful incentive structure, doesn't it? Because the more efficient the aid becomes, the more valuable the company becomes.
Which is exactly what you want. You want the financial incentives of the investor to align with the outcome of the mission. For 50 years, they haven't been aligned. Now, the proof is the product.
So let's just recap the thesis. You have the revenue dilemma, stability versus growth.
HumaTek attacks this with the dual action structure. Part 1. HumaDash, the sauce floor. It captures regulatory demand, generates steady ARR, and prevents the asset from hitting zero.
And part 2, HumaCoin, the token ceiling. It captures the volume and velocity of the money moving through the pipes.
Which is uncapped. As the network effect takes hold, and remember, the network effect is strong here, because if the UN starts using this, every small NGO has to use it to get paid. The volume increases, and the token utility scales.
It's a fascinating deconstruction of how to structure a modern company. It's a hybrid model that actually seems to work on paper.
It solves the biggest issue institutional investors have with crypto. They can't model the risk because there's no revenue. Here, the revenue is the anchor.
So what does this all mean for the future? We've looked at this specifically for the aid market, but I can't help but wonder, if we zoom out, this model seems applicable elsewhere.
That is the provocative thought I'm left with. If you look at the world economy, there are these massive sectors that are currently viewed as just cost centers. Black holes for money.
Like what?
I mean, think about public education spending. Think about healthcare administration. Think about defense logistics.
Defense logistics is a huge one.
These are trillion-dollar sectors plagued by the exact same problems. Opacity, friction, value leakage. You have billions of dollars moving through intermediaries, and you have no idea if the soldier got the boots or if the hospital got the medicine.
And right now, those sectors are totally uninvestable. You can't buy shares in government procurement efficiency.
Exactly. But if HumaTek proves that you can tokenize and monetize the proof of where money goes in the aid sector,
then why couldn't you do it for healthcare?
why couldn't you build a dual action model for hospital supply chains? A sauce floor for the inventory management software, and a tokenized settlement layer to capture the velocity of medical spending.
You could transform these uninvestable cost center industries into high-velocity asset classes.
That is a wild thought. You could effectively securitize the bureaucracy of the world.
And monetize the proof of process. It's a completely new way to look at value creation. HumaTek is starting with aid, but the architecture.
The architecture is universal.
Monetizing the proof. That is going to stick with me. It's not about the money itself. It's about proving the money moved correctly.
And getting paid for providing that certainty. That's the business model of the next decade.
It's a fascinating look at financial engineering. We started with a paradox, and we ended with a potential blueprint for the future of asset classes.
It's definitely one to watch. The structure is sound. The question now is simply execution. Can they get the big agencies to switch?
That's always the gamble.
Mhm.
But at least now we know what the bet looks like. And that is a deep dive for another day. We'll leave it there. Thanks for listening to The Deep Dive.
Catch you on the next one.